Let's go to our model and let's do our DCF. Remember in our cash flow statement, we got, let's move this over here, these free cash flow estimates, right? We calculated those. Okay, so let's look at a discounted cash flow valuation analysis. So remember, green means it's coming from other tabs. Step one, get free cash flow from the cash flow statement tab. Here it is. Okay, that's just linked directly there. See? Step two is calculate what's called the weighted average cost of capital, which is the discount rate that we're going to use to discount these free cash flows. These free cash flows today, meaning in 2016, should be worth less than they are then because you have to pay for money. There's interest rates. We have to discount it. But what interest rate do we discount these values to? Well, there's two things we have to take into consideration here. There's the cost of equity, right? And then there's the cost of debt. Okay. So the cost of equity, we'll go with that one first. The cost of equity is just the risk-free rate, right? Which is basically the government rate or a little bit above that, plus the beta, which is how volatile your stock is, times what you think the market return is going to be longer term, minus that risk-free rate. And so in this example, LinkedIn, oddly enough, has a beta below 1, which means that it's less volatile than the Standard & Poor 500. And then the stock market return in this hypothetical example is 8.5% over time minus the risk-free rate, which let's just call roughly 2.5%. And so that means that our cost of capital for equity is 8.2%. Okay. Now, and that's just math there, and we calculated that there. Now we have to multiply this, right, times what percent of the enterprise value or value of LinkedIn is equity versus debt. And so you can see there the market cap is roughly 15.9 billion. It's a little bit off. I'm not sure exactly where the stock's trading right now, but it's a touch off. And debt from the balance sheet is 1.13 billion. So that means the percent of the capital structure for LinkedIn that is equity is 15.9 billion divided by the debt plus equity, 1.3 billion plus 15.9 billion. That gets 93.4%. So 93.4%, right, times that, okay, is the cost of equity at 7.7%. And because we know that 93.4% is our equity as a percentage of our capital structure, we know that debt is just 1 minus that amount. Okay, that's it. Okay, great. So let's go into the cost of debt. Okay, so the cost of debt is basically the cost of debt we're going to calculate in a second, times 1 minus the normalized tax rate, because we do get that benefit of having debt. Okay, that's from a tax perspective. But it looks like, according to this comment, thank God I wrote this or I would have forgotten, all the debt that LinkedIn has is convertible. Therefore, assume the cost of debt is the same as the cost of equity, which is 8.2%. And now we're going to tax affect it because you get a tax benefit for having debt. And that gets you to 5.5%. Okay, good. And we take 5.5%, right? And we multiply it by the percent of our capital structure, which is debt. It's just basically minus the equity portion. So as a percent of capital structure. And that gets us to 8.02%, okay? And that's our cost of capital. And we're going to use this to discount all of these items back into today's terms, okay? Cool. All right, so let's do it. Now, I love this formula. It's the coolest thing ever. It's called net present value. Double click, and NPV is equal to the rate, and then the discount of all those amounts in the future. And the rate is, we've already got it. It's this dude here, okay? And these here, see that guy there? And then these here are going to be all of the future values we're going to discount to today. That's discounted cash flow, okay? Cool. That equals that amount. However, what the heck do we do with years 2021 all the way up to infinity? Certainly that has to count for something, and a much larger portion as well, because that's a gazillion years of free cash flow for LinkedIn. Well, the way this is done is as follows. You take what you think is the long-term growth rate, and the long-term growth rate for any company is 1, 2, or 3%. It's usually pretty low, and the reason is because when you get a very large entity, you get the law of large numbers. And so you look at the U.S. economy, for example, the U.S. economy is big, it's mature, so it's never going to grow more than just say a couple percent per year, okay? Okay, cool. So what you do is the terminal value is basically you take the last year, which is this guy here, the last year, okay? Plus 1 times the growth rate divided by this WACC, right? Weighted average cost of capital, which is 8.02%. Remember from up here, that guy? Minus this dude here, okay? That's your long-term growth. And you will never have your long-term growth higher than your cost of capital. It just doesn't happen, okay? And so we're discounting this amount right now in this next step here, right? That's your terminal value in today's terms. And we do it over 4 years. It's 4 years in the future, whatever. And then we've got our weighted average cost of capital there. Okay, good. So our target equity value of the firm is that plus that. Okay, that's discounted in today's terms. Minus the debt, that's our target value. Okay, there. And then divided by the number of shares, which is just from the income statement. That means our price target for LinkedIn is $157. Okay. Okay, cool. And that's at a growth rate, remember, of 2% in the long term, and a weighted average cost of capital of 8.02%. That's the WACC. Okay. And that's $157. Okay, that's our base case. Then I create what's called a sensitivity analysis table here. And a lot of analysts love to use this, right? And it's basically great because you can show your clients, here's a menu of where the numbers could be. You tell me if you're bearish or you're bullish. Okay, so if you're bullish on the economy or this company, LinkedIn, then longer term, you take a 3%, right? 3% long-term growth rate and a lower cost of capital, which means that your price target would be $328. And if you're bearish, then LinkedIn is only going to be worth $101 at a long-term growth rate of 1% and a weighted average cost of capital, which is higher, of 10%. Okay, good. So these 3 numbers are our bullish, base, and bearish case. Okay, so if we go here to valuation metrics, this will feed into there. And of course, they'll be green. And just look here. Don't look anywhere else. Thanks. I'm sorry, right here. This is the DCF methodology. Bullish was that amount, bearish was that amount, and just right was that amount, okay? And that came from the previous tab here. That's why it's in green.